Okay, hello everybody, and welcome to Investing with the IBD, sponsored by Vantage Point. Today is January 20th, 2021. I'm your host, Arusha Pierce, and today we have Jeffrey Hirsch on the show. Jeff is the editor-in-chief of the Stock Traders Almanac, and it is the 54th edition, Jeff. Congrats, and thanks for being here.
Great to see you have it already.
On today's podcast, we are going to talk about the current markets. We're going to talk about the January trifecta, and then we will end the episode with a few current ideas. Let's get into the current market. The market is in a confirmed uptrend. We have 3 distribution days on the NASDAQ, 5 on the S&P 500. Jeff, what are your thoughts on this market?
Well, we've got, a couple of concerns. The vaccine, the travel, leisure, pub, restaurant, service industry.
Right.
And inflation, maybe, if it ever shows up with all the fiscal stimulus out there. But other than that, it's pretty bullish. Cautiously, we've got a post-election year. We're going to get into that in a little bit. Post-election year is not as bad as they used to be, but technically, fundamentally, seasonally, things are pretty bullish right now. Sentiment's a little bit rich, a little bit high right now. It's come back. It's come off a little bit. We look at put call as well as the weekly one at Barron's. I gravitate to from my history of going through the lab pages, but and I missed the big picture in the paper. By the way, I know it's been a long time, but hearing you rattle it off like that, it brings back.
It is online still on investors.com.
I know, but it used to come to the doorstep or in the mail.
That's true.
And, investors' intelligence and some other sentiment measures have been quite elevated. Yeah. But like any type of top, these things can go on at those levels for a while. I mean, tops are a process, bottoms are an event, and it's the same with the indicators. They can stay, really overly bullish or, for the oscillators, for the contrary ones, for much longer than investors can stay short, unless you're like a Jim Chanos or somebody like that who shorts for a living. But
right, no, you're absolutely right. To the bull side, it's amazing at how long, especially just using the sentiment indicators, how long they can just kind of be pinned up there, and the rally just keeps going and going. Now, we are in an interesting part of the year. We're coming up to the end of January, going into February. Now, from my own experience, and obviously this is biased, I always seem to remember these times, for the most part, as some of the more challenging times in the market. What have you guys seen over the years, and what has the data kind of shown with this time period? Because there is a little bit of weakness usually that goes on at this time.
Well, January, still one of the strongest months of the year. Still part of the best 3 consecutive months, November, December, and January. However, we've seen January's performance come down in recent years, and I think it's become a bit of a profit-taking period, especially mid-month. And there was an old saying, or an old trade in the S&P pits, Chicago, that the January break, which is mid-month break, we had a little bit of that. There's a lot of bullish underpinnings here, but January is not necessarily is not a negative month. It's positive. It's given some back, and it's even stronger for NASDAQ. But February is the weak link in our best 6 months. And that's where we see adjustments after, the market looks at what happens in January, because that's how the January barometer existed. I don't know if you want to jump right in.
And we'll go into that, the January, but we're definitely spending.
But the reason the JB exists is because there's so many decisions made in January, economically, inauguration, states of the union, fiscal agendas, all that stuff. And we'll talk about the lame duck amendment as well. And then the market adjusts in February, and it tends to be this weak period. It's also, where winter gets a little tougher. I know out in California, you don't have it as bad, but you're still in the northern hemisphere, and it's still colder than it is in July and August. I know you're wearing wetsuits out there in July and August.
Well, we just got hit with an earthquake this morning here, so we have a few things we have to deal with. But I'm willing to take that because I'm from the Northeast. I'm willing to take that occasional earthquake versus the consistent snow and lack of sun that you're dealing with right now?
Yeah, we got some sun. It hasn't been bad.
Oh, good. Okay.
It's typical January, 30s and 40s, partly
Not bad.
cloudy,
Yeah.
some weather. There's a flurry. There'll be some snow, but anyway, it tends to drain on people. A little cabin fever hits in February on top of the President's Day break, and people tend to sell into that and around that. So, it's not January as much as it is February.
Okay, and that makes sense. I always
more the
fear
indicator month. Sorry?
Oh, well, I always fear February personally.
You should.
Yeah.
It begins with F, just like fear.
Exactly. Yeah. So, Jeff, before we get into a lot of these really interesting indicators that you and your father, especially your father, really kind of came up with these years ago, let's talk about your background, how you got into this. Walk us through that, because it's a really cool story.
Well, it's kind of by osmosis, born, bred, weaned, raised on it. I fought it for many years. Yale started Stock Traders Almanac the year I was born, 1966.
Wow.
He went out on his own and started a company when my mother was pregnant with me. For the record, my mother passed December 19. She's been gone over a year, but Dad is still rocking and rolling at 97. He's at the nursing home. He's got one vaccine shot in him, so we got that going for him. Good. I get a test, a rapid test every time I go to see him. But so Yale had been working with Indicator Digest, which was a newsletter proving grounds for analysts and writers out of Palisades Park, New Jersey, started by his cousin, my godfather, Samson Kozla, who I named my first son after. Sam was a songwriter in the Songwriters Hall of Fame, wrote Cocktails for Two, Mild Flame, and also produced the movie Copacabana. I think he had an Oscar for a short or something like that, or some whatever. But Sam had sold his publishing rights to this company, to RCA, for stock back, and it was like before the crash or something, and he got burned. So he became a student of the market. Obviously, not a dull guy, pretty sharp.
Yeah.
And he ended up writing a book called Super Yields, which was in the 50s, early 60s. And went out and ran an ad. We used to run ads with you guys in the old days.
That's right.
We had great advertising success.
I remember that.
IBD, the paper. Did the same thing in Barron's, and he ran an A/B split on two presses. Where you have the same exact ad, one headline on one press, and so you're testing a headline. You're always supposed to be testing when you're marketing. If you're not testing, you're wasting your time. Anyway, you guys know all that. So Absolutely. He ran the ad, with the tear off coupon in the corner with the dotted lines around it. And Yale was working in the music business, writing songs and stuff. Actually, I own one of his little publishing companies. Got a couple of tunes in it that it doesn't pay much, but it's just interesting.
That's so cool.
So the ad hits. All the coupons come in the mail, and he calls up Yale and says, "I need you to run operations." This was 61, I think.
Wow.
So they spent the next 4 years cranking out this investment newsletter business. This is when it was really hot. I just heard something. I was talking to Kelly Wright at IQ Trends the other day. We did a panel at Money Show about stocks, same stocks we're going to talk about later. But he was telling the story of Geraldine Weiss. I don't know if you know who she is. And she started in 66 also. And she used to go under the pseudonym or the name G. Weiss, because nobody wanted to take investment advice from a woman back then. Anyway, I digress. So he incorporates the Hirsch organization, spends the next year and a half compiling all the information. He learned all of these indicators, patterns, trends, seasonalities, and wanted to put it all in a calendar format so he could follow the markets calendar along with his own throughout the year. Okay. And he came up with this epiphany to create the Stock Traders Almanac. It's evolved somewhat over the years, but you've got a few copies. It's still basically the same. It's gotten a little bit easier to use, a lot easier to use, a little bit better. We've taken some things in. Things have been relegated to the indicator graveyard. New indicators have come in. We've built on other things, but then I come along, and in 73, I guess going back when the first year, 67 to 68 edition comes out, he sends a salesperson out to the brokerage firms in New York City, going door to door, just pounding the pavement. And he sold a whole bunch of these things to brokers, giving them away as clients, We always imprint the logo on there for the firm.
Yeah.
And it hit, and it stuck. And obviously we've been doing it for 54 years now. Must be something redeeming about it.
No, it's an institution now. I mean, everyone's heard of the Stock Traders Almanac. If you're into investing, or even if you're on the periphery, so it's just one of the coolest publications out there.
And then people were clamoring for more. So we started a newsletter in 73 to update people throughout the year called Smart Money.
Okay.
In 81, he was a big stock picker. Dad, Yale. He liked the small caps, the micro caps. He liked to swing for the fences a bit. I'm a little different now, more along slim lines, but
right.
So then as a kid, I learned how to work the mailroom. I answered the phone. I mean, Hirsch organization, can I help you? It was like,
wow.
I wake up like that. We had
when did you start working there?
Well, basically when he moved the office back to the house, he started to dislike commuting into the city, and we put on a new garage. He turned the old garage into an office, sheetrock paneling, the whole thing. He had the women in the neighborhood who were coming back to work from raising kids, who were all, smart and talented. And I started in the mailroom. God, I must have been about 10, 12 years old, maybe,
so cool.
Somewhere in there, helping out, loading up the truck, shipping books, taking I'd come down. Actually, I used to do it on Monday Night Football. Bring TV from the kitchen downstairs.
Yes.
And go get all the, the typed up labels and invoices and pack them all up in jiffy bags and boxes, and then stack them up in the new garage where we had a book storage section.
Yeah.
And then the UPS truck would come in and load it up. And then I started running numbers for him, not like not a bookie, but doing the calculations, old school. I have the little ruler that I used to use. It's at my regular office, not the home office where I'm at today. And it was a short little ruler from like Dykeman Street Lumber. I don't know, some staple, something in Yonkers, some stationery store. And I would run my hand down a Barron's Lab pages and underline with a red pen up half-hour ticks, or hour ticks from back in the old days, and then up the days, on the indices that were up from the other. And we'd do the calculations on graph paper with an adding machine, just like using
wow.
And then, just to not make it too long of a story, make it short. When I started working for him, which I guess I could fill that in, I turned it into, converted a lot of that stuff into Excel for DOS back in like 92, and then Windows 3.1. And now my current partner, it's on a piece of software that we've written, that we run. So I don't have to do that stuff. We still enter, upload the data ourselves. And at one point I went back and I cross-referenced the data from 3 different data sources and, made sure we had the right numbers for each day, at least the daily closes.
Yeah.
So I spent some time, avoiding not wanting to work for my father, do my own thing. And then, I was landscaping. I was getting into that business. There's money to be made there. I like being outside. I like the smell of 2-cycle oil and grass clippings. I still do.
And how long did you do that for?
That was like, high school, late college.
Okay.
Like in the 80s, and I was done with school, working for a firm in the fall, and I think it was 89. And my buddy, my oldest friend in the world, who I've known for, 51 years, 51 and a half years. I met him in 1970 when they moved in across the street.
Wow.
He says to me, "What are you doing, man? Go work for your father." I'm like, okay.
Really? It was that simple?
Well, I mean, it was kind of that simple, We were having a bigger conversation, but that was the end of it. And so I went in, and I was kind of half working for Dad and half landscaping and doing both.
Yeah.
And he's like, "What are you doing, man?" And then I said, "I want to work for you, but I want a title and I want a salary, and I want to be clocking in." And then the rest is kind of history.
Yeah.
But they said, we did a lot of different things, and at one point we were running 7 newsletters, different partnerships. We had a Beating the Down newsletter, mutual fund newsletter. He had a whole bunch of publications that he went through over the years too. So It was good. It was a lot of fun. Still is. I'm still doing it, you know?
Yeah, and you've also expanded the business now into other areas. That you're doing you're in some a mutual fund or
Mhm.
funds too, right?
Yeah, I mean, this guy Joe Childry was a branch manager broker at Wells Fargo towards the end, but started with AG Edwards. He'd been other places before, and unbeknownst to me, we one of our big clients for buying books was AG Edwards. We used to
Okay.
do like 2,000 of them for them, and
Wow.
they'd sell them in their catalog for brokers to buy, for advisors, whatever, to pick up for client gifts. It was in their catalog for brokers to buy stuff. I still say brokers, advisors. Um, and Joe was an AG Edwards guy, and he was at La Jolla, and he was a big producer, and he always had the Almanac on his conference table in his office,
Hmm.
and he got one of these sort of bucket list, or like maybe it was a big producer trip. It was a safari to Africa. So he's going to get to the airport, and he's leaving from the office, and excuse me, he left his reading material for the flight at home. So he grabs the almanac off the table, brings it with him, spends the next 2-3 weeks with nothing else to read but the almanac.
Oh wow.
Comes back, a convert, trend following convert, starts to trade it for his own account, and then for some client accounts. And then, he did a bunch of research with a math whiz PhD who's in the business, Dr. Alan Shepard, related to the astronaut, by the way, but spelled differently. And he did all that research in, I guess, 06, 07, and launched a hedge fund in 08. Tough year to launch a fund.
Yes, not very good timing there.
He was up about
Wow.
5.25%. There were
Well
some
done.
volatile swings, and they were a little bit more leveraged than we are now, because we converted it to a mutual fund back in 2013. He went 40 act with it, and we do a VIT, variable insurance trust, as well as, and then a little bit later, the mutual fund tickers PROTX. There's also an A share, I think it's PROAX and PROCX, A share and a B share, and a C share, excuse me, for different loads on it. And when he did that in 2014, they were buying almanacs the old fashioned way, with imprinting the logo. It's called Probabilities Fund.
Okay.
And which I kind of like, with our
I like that's great name.
our market probability calendar in the back, with all of the different trades per day.
Yep.
The probabilities of what the market does on that day, and we also have it on the on the calendar diary pages on the right hand side. Those little numbers, as you I'm sure know from your use of it. So they were buying almanacs. Wiley's still our publisher right now, and the Wiley had a deal. You buy 500 almanacs, you get a free webinar with Jeff. So Joe and I met him at a money show in San Francisco, which is where you and I met, at one of Vegas or whatever.
Yeah.
And I think that was one of the ones my wife came with me. It was like summer in California. And we hit it off, and we started consulting with him for a couple of years. And now myself and my business partner are part of the firm, so I'm the chief market strategist, Probabilities Fund, equity, owner, as well as with my director of research, Christopher Mistel, who's, none of this would be possible without Chris, by the way. I mean, he's the glue, and he put Yale's brain in a piece of software and added his own brain to it, which is quite substantial. And that's what we're up to these days.
No, it's really cool. I mean, it's just great to see that history and kind of the transfer of knowledge, and also the expansion to other vehicles too. So the market is in an uptrend. Growth stocks continue to hang in there, but remember to be aware. We are pretty extended. Lock in some gains when you have them, and let the market in the end also tell you what to do. Let's take a quick break, but when we return, we are going to talk about the January trifecta. We'll be back. Want to dominate the stock market in 2021? With the COVID vaccines, the shifting political landscape, and a new year, It's virtually impossible to guess what will happen next. But with Vantage Point, you don't have to. Visit www.freestockcoaching.com and find out how Vantage Point's AI technology can forecast stock market trends up to 3 days in advance with incredible accuracy. Vantage Point's patented technology analyzes huge quantities of global data in seconds. Stop guessing. Check out www.freestockcoaching.com and experience Vantage Point for free. Trading involves financial risk and is not suitable for all investors. Past results do not guarantee future performance. Jeff Hirsch is our guest on Investing with IBD, sponsored by Vantage Point. Okay, Jeff, let's get into the January trifecta. And so I guess the first question is, what is it?
Well, you got to add another word in there. It's the January indicator trifecta.
Oh, okay.
It's 3 indicators.
Yep.
2 of them created by Yale, one of them that he helped to popularize. You have the January barometer, which Yale invented. As January goes, so goes the year.
Mm-hmm.
With the S&P 500, that's the full month January barometer. Then the Santa Claus rally, which everyone misstates every year. It's something that Yale discovered. It's the last 5 trading days of the old year and the first 2 of the new year. It's a 7-day trading period. The phrase that you've heard, if Santa Claus should fail to call, bears may come to Broad and Wall. That's my father's line. He
That's
wrote
incredible.
that. Songwriter, if you remember from our previous segment, we discussed that's where he was before he started.
Yeah.
And that indicator is, there's a usual 1.3%, gain in the S&P 500 during that period where many of us are out gallivanting or celebrating or away. And the pros kind of come in and pick up the beaten down stocks or rally the market.
Yeah.
Years when that doesn't transpire, we've had some, flat and down years. The last, couple, 08, 09, or 07, 08. I just flipped back to the book. There was the, this is page 112 in your, 116.
All right.
So you had, let's see, 2015, we ended up with that little bear market in February, that bottom. You got 07, 08, we had the big crash. 04, we had a flat year. 99, 2000.
Yeah.
Back to 94, we had, 93, 94, we had a flat year. So it's basically an indication that, if people aren't buying at that period of time, it's a little bit of a warning sign for what's going on in the year. And then you had the first 5 trading days of the year, which is the older one, the first week of January. That's not something Yale created, but out there. So we took all 3 of them.
Okay.
And combined them. Now, let me just pause for a second. The reason the January barometer works is something called the 20th Amendment to the Constitution, the lame duck amendment, which was passed in 33, but not fully ratified until 34, 35, and didn't take effect until 1937 for, was that Roosevelt's second term, right? If I'm dialing all this up down, the second term. It's actually, I'm working on a little post for that. Yeah, that's his second term. And what happened is they took, when new Congresses were elected in the previous November, they used to be lame ducks, where they were in office for another 13 months till the following December when the new Congress convened.
Oh, wow.
And presidents were inaugurated on March 4th, which had a lot to do with the old days when people didn't have automobiles and planes sticking around in, and there were different seasonal responsibilities that these people had back at their homesteads and farms, like John Adams and those types of people.
Yeah.
So the 20th Amendment to the Constitution took new Congresses convening into the first week of January, which we saw this year.
Yep.
Just, a month or about 2 months after they were elected, and new presidents being inaugurated on January 20th, which ironically, or at least wonderfully, is today,
right,
as we're recording this. What that does is it also brings all of these other important events into China. You've got, policy initiatives, setting priorities for the country, the forecast from folks like myself and all of the big wirehouses in Wall Street and people readjusting money in year end, which I think is probably not the best time to make your big moves unless there's a couple of some small cap type trades you're making. I'd rather see people making their moves in September, October, and April, May, June than around November, December, January. But that's another story. Maybe we'll get into that. So all these important events are packed into January, and the market reacts to them. So what the market sees, what's going to potentially happening ahead, you've got a little bit of a barometer, a pretty solid one where, it's only 10 major errors in about 70 years. Is that the whole thing?
I want to say that was it, but I'm looking.
Yeah, and even when you include, it's an 85% accuracy ratio.
There, 85.7%. Yeah.
Yeah, and then when you add in all the flat year errors, where it was up or down, plus or minus 5%, it's still 74.3% accurate. Granted, there's an upward bias to the market, and if you take some of the debunkers or the skeptics that the market's going to be up that much on any given chance, that's fine. But down January's still have a solid record, and we saw that this year, and we also see the December low crossing thing. So January indicator trifecta, combination of the Santa Claus rally, the first 5 days early warning system, and the full month January barometer, all based on the S&P.
Okay.
And I can show you the amazing results if you'd like. If I can share my screen, if that's
share your screen. So far we have 2 out of the 3, right?
Correct.
Right. So
be positive.
Yes, 2 are positive right now.
This is from my newsletter page. This is a subscriber login. This is
and Jeff, for those of you who are listening to the podcast, when you get a chance, go home, go to investors.com/podcast. You can see the video version where Jeff is showing this table of the January trifecta,
which of course is at stocktradersalmanac.com.
Yes.
So what you see here is the last 31 times that all 3 were positive, going back to 1950. Okay. I can explain to you why 1950 is relevant later or in a moment. But of the 31 times, the prior 31 times that all 3 were positive. Now we've only got 2 positive right now. Santa Claus rally, first 5 days positive. January's looking pretty good right now, but it did last year until COVID hit on the last trading day of the year. So, that's why we wait.
And last year it finished negative 0.2%. It was like barely under, right? But by the end of because I remember we were watching it. I was watching closely because you told me about this last year. I was like, oh my God, we didn't hit it.
It was indicative last year.
Yeah.
Yeah. I mean, even though we had a great year over year, performance after the big snapback and all the stimulus, we still had a pretty nasty correction that
absolutely
was troublesome for a lot of people. So 28 out of 31 times the market was up full year, 27 out of 31 up the last 11 months. We like to, take the January out of the calculus. 11 months, 12.3% average, and the full year, 17.5% average.
Wow.
So something to keep in your indicator quiver at month end. Yeah. So again, here we are standing on top of Yale's shoulders. I think it was Isaac Newton that said, if I've seen further, it's by standing on the shoulders of giants.
I like it.
It's one of the quotes I put on a page in the Super Boom book when I'm referring to Yale and how he discovered a bunch of things.
And so the 1950, explain that quickly. Also, why that's significant.
I show a chart of seasonal pattern. We do a 1-year seasonal market pattern. And, we have the best and worst 6 months, the sell in May and buy in October, whatever. Most of the market's gains have been since 1950, have been made from November to April, May to October, generally flat. Okay. And what happened before 1950, this was a farming agricultural economy where most of the cash flows in and out of the markets came from agriculture. So we have a growing season. You can see it was pretty much buy in May back in the old days. That's when, reaping and planting and hiring and equipment and fuel and seed and fertilizer and everybody started working up through harvest time when, everything came to market, and then it faded off. So then you also had what Eisenhower called the military industrial complex, which began post-World War II. So a lot of this is post-World War II, but, there was a bear market after World War II. And there was also, a little sort of a sell-off, post-war sell-off. And then the first full 4-year cycle, the presidential election cycle, starts in 49. We often use 1949 for a lot of, references, but 50 is also there. So that's why we look at that point. And now we have the, service, industrial, tech economy that doesn't really, that more revolves around the vacation period, which equates to the old selling, the old phrase, sell a man, go
Sell
away.
a man, go away. Yep.
Coming back on St. Ledger's Day. You know that part of it? The old British.
No, I don't. I do not know that part.
So you ever see Downton Abbey or watch any of those British,
a little bit of those.
So what happens is they have something called the London season.
Okay.
Which is like September through May. So London was built on a swamp. It still gets kind of muggy. Now they actually have air conditioning and ice cubes in England. They didn't used to about 20 years ago. But people have this tendency to do things during the warmer months with brighter light. I mean, I play a lot more golf from May through September than I do from September through, even though we did play some into December this year. People go away, they take vacations. You see, we have a whole page in the Almanac about the summer doldrums of volume trading.
That's true. That's absolutely August. Yep.
I'm sure you've seen that.
Yep.
So the old sell in May and go away and come on back on St. Ledger's Day refers to the St. Ledger's Stakes horse race, the final leg of the British Thoroughbred Triple Crown.
Wow.
Which is the final event from all of the royals and merchants and aristocracy coming back from their country homes after their summer of fox hunting and horse racing. They come back to the city. I'm being a little bit, tongue in cheek here.
Yeah.
See it.
Yeah.
But that's how and it works with us here with the Memorial Day to Labor Day summer vacation. And all these patterns are based upon behavioral patterns, behavioral finance patterns of what people do collectively, almost sociologically, with their money on a regular basis. Whether you go down to the intraday trading patterns that we have in the back of the book, or the multi-year patterns based upon what we call the quadrennial quadrille, the 4-year election cycle dance, or the monthly, quarterly stuff around triple witching. I mean, there's events that make people behave certain ways with their money. People pay their bills about the same time every month, or hopefully they do, and they try to.
Yep.
That's why we have the monthly, what used to be the 5-day bulge. Now we call it the, the Super 7, Super 8 days of the month. And then here's something we discovered. This might be one of the things that you wanted me to get into. The new indicator, or the new monthly pattern, was something that Yale actually discovered while I was working for him in the 90s. We saw that instead of the strength being at the end of the month, and the beginning of the month was like the last day plus the first 4 of the new month, where a lot of money came into the market because people were doing transactions on their month end, financial activity. We saw this mid-month spike in the stock market regularly. What happened? You had the mutual fund industry and the 401k retirement industry with the bi-monthly payrolls, people getting paid on the 1st and the 15th, or whatever, the 30th or every 2 weeks.
Yeah.
So you see the 9th, 10th, and 11th trading days of the month become very strong. And this is the kind of stuff that probabilities fund is based on. We look at a bunch of other things, but it's basically the repetitive behaviors of people putting money in and out of the market, and the fund managers, the big, institutional money, having to take that money and put it to work. They're not even picking stocks or making investment decisions. They're saying, well, we get all this money every month at this day. It's got to go into our allocations, to our models, or whatever it is. So that's what creates those, the typical month, the monthly cash flows. I mean, there's charts on every Almanac page in the book for February. You can see those bar charts. That's what's depicting. And those were the calculations I used to do by hand in the old days.
No, and so now talking about cycles and things like that, as you mentioned earlier, it is Inauguration Day today. Talk a little bit about the presidential cycle and also the post-election years syndrome.
This is a quote from Nixon. I'll read it for the podcast, the audio people. Richard Nixon in 1960. Early in March 1960, Dr. Arthur F. Burns called on me. Burns' conclusion was that unless some decisive action was taken and taken soon, we were heading for another economic dip, which would hit its low point in October, just before the elections. This is from Nixon's Six Crises book.
It's incredible.
Burns was his economic advisor and had a very infamous stint at the Fed as a Fed chair. Didn't last very long there. But what this tells me, it's one pregnant phrase showing a president and a Fed chair economic advisor highlighting seasonal market behavior and 4-year election cycle behavior.
Yeah.
So the post-election year has been the worst, used to be the worst year of the 4-year cycle. I'm showing a chart here of the 4 years, the post-election year, midterm year, pre-election year, election year. Election year, the third year, as presidents prime the pump to get reelected, much stronger, up 16.2% on average since 49 for the Dow, up 29.3 on average for NASDAQ since 71, when NASDAQ was first, became not just over the counter. And you see the election year's performance coming down. We've got some battleground, 365 campaigning, or I think they campaigned for 4 years now, pretty much.
That's true.
And you still got the midterm election issue, which is something to look at for next year, for 22, when, there's going to be a pushback from the Republicans to try to take control of one or two houses of Congress. And that creates something we call midterm bottoms. But maybe we'll do a podcast about midterm years next year.
We have to, yeah, exactly. So now, the post-election there, 12 for the NASDAQ, it was 12.6%. So hopefully good news there.
I would even venture. I mean, we made an annual forecast. If our best case scenario comes to it, it'll probably be more in the 20s, 20 to 30%. If the vaccine rollout works,
and a lot of money being pumped in,
and we get people back to normal a bit,
right? We
could have a big year again, because there's a lot of pent up demand.
It's true.
And even though there's been a decent amount of sales, it's still down. So the syndrome you were talking about,
yes.
Bear markets, big bear markets in 29, 37, 57, 69, 73, 77, 81, 01, and 09.
Yeah.
We had wars beginning, civil wars in 1861, World War I in 17, World War II in 41, Vietnam in 65, really. And then we had 9/11 in 01. After the 29 crash, we had 4 straight up years, with 33 being up 67%. So this is when the 4-year cycle is a little bit, overridden by other forces.
Okay.
And you've got the secular bull market in the late 80s and 90s, with 85, 89, 93, and 97 being all up. Here in the 21st century, 01, as we mentioned before, and 05 were down. Okay. 09 was up 19% for the Dow, but it was up 59% off that big secular bear market low in March.
Right.
There's another whole podcast to talk about that big move there.
Yeah.
In 2017, the last post-election year was up pretty strong.
It was a unbelievable year.
25% for the Dow.
Yeah.
So we also look at political alignments. I'm showing a slide here. Let's go all these different matchups showing Republican Congresses and Democratic presidents are the best, up 16.4%. But it's really not the president's party per se. It's what the congressional makeup. Republican Congresses 14.6 versus 10.1 for Democratic Congresses. But just to sort of trim this down, we have a Democratic president, and we either have a Democratic Congress or a split Congress. I would contend it's split because of the Senate being 50-50 or even 48 with 2 independents. And then Vice President Kamala Harris having the tie-breaking vote. So there's a discussion about, a power share with McConnell and Schumer. So 11.7% for Democratic presidents with a split Congress, 7.4 for Democratic presidents and Democratic Congresses. Lower with Democratic Congresses, they tend to push a lot more new spending through, which sort of taxes Wall Street a bit, a little more regulation, and that's why that number is there lower. And then the chart that's in the Almanac that you have in front of you, I think page 9, if memory serves, right?
I think it was 9, yeah.
Where it shows post-election patterns after incumbent party wins and incumbent party losses. Incumbent party wins much stronger, up almost 12%. Incumbent party losses just over 2%, and all post-election years about 7%. But we looked at it, we drilled down a little bit deeper, and this was posted, sent to press in July of 2020 when we began to lay out the Almanac for publishing. So that was that cutoff date, and it was July 22nd.
Yeah, July 22nd.
And then we were looking at, once we saw that we were getting a first-year Democrat, we looked at the numbers, and first-year Democrats, we've still got post-election year after incumbent party loss on there under 2%. We've got all years from 49 to 2019. I always look at 88 and 2019 for the seasonal patterns, because after the 87 crash, the market was changed systemically with the collars and circuit breakers, and
that's interesting.
Not quite as left ungoverned, and of course all post-election. But first-year Democrats up 10.6% on average, a median gain of 15.1, but it's only 4 since 1949 that we had first-year Democrats. Kennedy, Carter, Clinton, Obama, all 4 came in with Democratic control. The only loser was Carter when we had that big stagflation, economic, malaise, crisis of confidence, if you will, back in 77, and there was some oil embargoing things going on there as well. So that's the basic post-election year syndrome with a little bit of a current year wrinkle on there. So,
well, that's a perfect way to end this segment. So, knowing where you are in the market cycle and also knowing what season it is can help you improve your success in the market. Coming up next, Jeff and I will talk about a few ideas. Stay tuned. Tired of reading about other people getting rich in the stock market? Today is your day. Vantage Point's artificial intelligence has predicted countless market reversals, helping traders weather any storm up to 3 days in advance. Visit www.freestockcoaching.com and find out how their AI automatically recognizes global market patterns well ahead of the news to help you pick the best trade. Go to www.freestockcoaching.com to join a free live training session today. Don't delay, save your seat now. We are back with Jeff Hirsch on Investing with IBD, sponsored by Vantage Point. Okay, Jeff, let's get into a few ideas here. And the first one is ticker symbol AVID. What I'm going to do is Avid Technology. I'm going to share my screen. And here, I pull up the Marks Book chart. This is on a weekly chart right here. Jeff, what do you like about Avid Technology?
Well, I'm going to give you a little overview on how we pick these stocks while we're looking at this. Always been a fan of CanSlim and like the systematic metrics of it. We have our own system. We think we can get in a little bit before. Some of them are a little bit smaller, so we're sort of like pre-CanSlim. We do a pretty heavy-duty fundamental screen, and we do use Market Smith. We're subscribers to that. That's part of our analysis. So, and we also have our seasonal overlay. So we're not getting into new stocks at any time of the year. We're getting into new growth stocks somewhere in the September to November period, around when we get our best 6 months MACD buy signal. And we do a pretty robust screen. We also use the Zacks Research Wizard to scan, just because we have an arrangement with them, to scan the universe, about 8,000 stocks. And we look at not just revenue and earnings growth, but revenue and earnings growth acceleration.
Okay.
And we look at valuations, PEs, price to sales. Price to sales ratio is the first thing I learned. I used to analyze stocks a lot more individually with the stories and stuff. And now we just look at the numbers, really. We find out about the story later. Like we had Scott's Miracle-Gro was a pick for us a while back. Like, well, it's throwing off good numbers. What the heck?
Right.
In this industry.
Yeah.
They were selling a lot of the, they bought a division that sold a lot of hydroponic stuff and fertilizer. So
they want a huge run.
Often we'll find out later what they're about. So we run our fundamental screens, growth, acceleration, valuations, make sure there's some liquidity and decent level of market cap. And we break them down into small cap for us is under $1 billion. Mid cap is 1 to 5 billion, and large cap, which is not really everyone else's large cap, is over 5 billion. Our large caps are probably other people's mid caps.
Mid caps, right?
Vice versa. And our mids are smalls, and our smalls are maybe micros. We don't go to the old school. What is it? Nano caps or whatever they call them now. I'm not sure what the word
or micro cap or something like that.
No, there's now.
Oh, is there nano cap? It's out even
like, the stuff that's like $50 million. That's
Oh wow.
If it's not of a certain price and of a certain liquidity, we're not publishing it.
Makes sense.
Then we screen them, we compare them to the market, so it's not just in a vacuum, it's relative. And we also want it to not be underperforming or outperforming the market to the S&P. And then we look at analysts. Now, we don't care what the analysts say.
Mm-hmm.
We want to know how many are following it.
Okay.
And all things being equal, 2 stocks, similar numbers, one's being followed by 20 analysts, one's being followed by 5. We're going with the one with 5, under Wall Street's radar. So companies that are quietly growing revenues and earnings, good valuations, not underperforming, not outperforming, sort of below the radar.
And they're naturally going to be a little bit smaller then too, if they're underfollowed at that point, right? For the most part.
Precisely why our capitalization numbers are probably skewed a little bit smaller than others.
Yeah.
And then we go to the charts. Then we'll we'll drop in those. We get the 8,000 down to about 50 or so stocks. Then we'll run them into Market Smith, and we'll look, and we'll use your comparisons, which I love. We'll compare it to Shaughnessy or O'Neill, and
okay.
We'll look at some of what other people think. We usually don't get as positive ratings, but we look for some coverage in there. And your chart patterns we're looking at, the cup and handles and the breakouts and all that stuff as you're showing here. And then we'll narrow it down to the ones we like, and then we'll go into another technical charting software that we use. It's Trade Navigator, and look for buy limits or buy points using old school technical analysis. Gaps and consolidations and pivot points and candles and things like that, and kind of use the old art of technical analysis and pick a spot where we like it. We don't get them all. So long story short,
so this one, Avid Technology, this is one that's come up on your screen.
This recently is one of the ones we put in our November stock basket.
Okay.
Which I picked out 5 other ones. There's other ones. I picked out the more techie growth ones because we think that's, you could go wrong with a regional bank or a oil and gas producer, something like that or something like that. But tech's where it's at right now. So there's more stocks, there's more conservative ones on the list, but I'm bringing you 5 to give you guys an idea.
And Avid Technology's been in just an incredible uptrend since November.
We've added it to November 13. I think we put the list out on the 12th. So the next day, it traded below our buy limit at 1069.
Okay.
Yeah, you got it right there. So it's up for us from there. Okay. Now, these are not stocks that I know the whole story of inside and out. And we pick them, we look at them, make sure they're for real, and then we get a better idea. So the Avid happens to be pretty cool. It's at the forefront of the digital media revolution. And it boasts pretty stable of industry-leading software and partnerships. Mm-hmm. So as the economy, began to recover from COVID, people ramped up digital media. What we're doing now, you were doing this anyway prior, but there's a lot more of this stuff going on out there. Yeah. So their media production and publishing revenue and paid subscribers pick back up. They have this open and efficient media platform, and they've got a whole suite of comprehensive tools for creating, producing, distributing, and monetizing feature films, television, music recording, other live events.
That's a sweet spot these days. That's what everyone's doing. Yeah.
It's a nice suite
of
tools.
Yes.
But, it's not the kind of technology I'm personally using. I'm Zoom and PowerPoint.
Yeah.
But people are doing stuff out there. Like somebody might be recording us live using their stuff.
Yeah.
So, again, we update our buy limits, and a lot of people recommend stocks, a lot of, organizations, newsletters. So one of the things we pride ourselves on is not just what to buy, but when to buy it and at what price and where to place your stop. We do, listen to the IBD 7-8% on the bigger caps as a framework, but we'll look for points on the chart here. I don't know offhand where the stop is. I could look it up on this, but it's in our portfolio. I mean, you've got this June 19 high I'm looking at right there. Just eyeballing, way back here, June 2019.
Oh, okay.
Yeah, put that cross right on June 2019, that peak. That somewhere in that area where that consolidate, and maybe not the very peak, but some sort of that's looking, and then you got that candle or that open high low close there just towards the end, right where we bought it.
Oh, okay, over here.
Yeah, that's kind of getting into a stop area, right where your line is, somewhere in there. You understand what I'm saying. So that's how we pick our stops.
Got it.
And then we'll raise them up.
Makes sense.
We'll have a pivot point on there. We might look at the 50-day. So that keeps moving up. We update those monthly.
No, that's in a strong trend. Let's go to another idea here. This is LMAT.
You want to come something for me?
I was hoping you would.
I think it's like Lemaitre.
Lemaitre vascular. I'm not sure.
I looked into this. This is a company that makes very specific, vascular tools. They have stents and procedures and treatments for some very peripheral vascular diseases. And they've managed to stay small and really, it was started by a surgeon looking for better solutions. Yeah. So they continue to add, what do they call it? Indications where they can use the same thing for different things. And they've also acquired some other stocks. Some other companies, and that's pretty much the story there. We got in there at what 37.29 on the 13th also. Right?
Okay. Yeah. So right around here.
Right around here, we had a little dip.
Yeah.
Not perfect, but we held our stop level.
Yeah.
I don't know where our stop was, but I could go check it from you. Obviously, above that level because we didn't get there. Is that a pivot right there? Well, who's that pivot you hit?
Well, the pivot was there. There was a couple with handle actually that you were actually buying out of there too.
Right. So I mean, this is not. It's not a coincidence that your chart patterns here are jiving with the picks that we made here.
Right.
We use Market Smith. I mean, we love it.
It's very cool to hear.
I just missed the newspaper, but whatever. Even if it was PDF or something, maybe you'll have to get me back in so I can look at the big picture because I missed it.
I'll show where it is. Okay, so that was LMAT. Let's go to another idea here. This is OSIS. OSIS.
Get a little bigger. You got a little more market cap here. This is a mid cap one. The first two were small caps.
And so now this is the aerospace industry.
They're the ones that make. They also do monitoring for
medical monitoring,
anesthesia, delivery, ventilation, defense and aerospace, medical, industrial.
Yeah.
Security and inspection systems, turnkey screening operations, and integrated solutions. As you can see, I'm looking down at my notes because we don't know. We're not like story stock.
And that's fine. Yeah.
We learn about them later, as I mentioned with the what was it? What's the big cloud computing one? Arista Networks.
Oh, ANET. Yep.
ANET came through us through these screens, and then we found out what they were doing. It's we put stops in also. So.
Well, I mean, that's the beauty of using technicals. So sometimes you just go with the trend. You see something's going on, kind of like what you're talking about with Scott Miracle Girl. Mm-hmm. You're like, something's happening here. I don't know what yet, but let's get in it. We have our stop to protect us if it goes against us, and then we can learn about the story to figure out whether we should hold on to it longer or whatever.
I've had a similar experience with the seasonal patterns and the seasonal indicators. We know it's working. Not exactly sure the behavioral finance behind it, but we'll try to figure it out later.
Well, yeah, I mean, you were raised on this, like to listen to the market in the end. Listen, there is a seasonality to it. There is a rhyme and reason, but you don't want to overthink it, right? You want to go with the flow.
But the years of cross-examination by people like yourself and others, have forced us to find the correlation. And correlation is important. You don't always see it right away, but if you can go back and reconstruct it, that's helpful.
Yeah. So here's one that it's trying to go. It's still struggling a little bit here, but it's one worth keeping an eye on.
Consolidation you got over the dotted lines.
Oh, I'm sorry. Say that again.
Back in 18, there's two. What pattern is that over there? You got an old
over here. There's a consolidation that was forming, and then out of here is a flat base.
And what's that blue line right there? The blue bar
here.
Yeah.
Well, this is well, you have a couple handle over here. So actually, once again, you're kind of buying. Actually, it was surrounded.
We picked it up right there.
Yeah.
At 83.98 on November 13th.
Yeah. That's funny. Wow.
It
and it went up 20. It went up 20% from there. So you're currently up around like 17% from that cup with handle that was finding too on pattern recognition.
We stand on Bill O'Neill's shoulders also.
No, many people do. So that, thank you for saying that. That is awesome. Always amazing to hear. AVAV. So one more we'll go over.
It's kind of a bad boy style, not a bad boy, a badass style. They make weapon drones.
Well, they have the drones. That's always what I remember.
They have these. I don't know. I forget what the name of it is. They have this unmanned missiles. I mean, this is like combat theater stuff. Unmanned aircraft, global leader. They supply military and homeland security and surveillance solutions. They also help telecom people, find out that link millions to the digital economy. This was picked up same date, the 13th. We all recommended all these on the same day at 80.45.
And coming out with a cup of the handle too, right here too.
Yeah, and where's the 13th? Right there.
Right there, yeah. Well done. I mean, you're up 69% in 12 weeks on this one.
We haven't been in it for 12, have we? Is that? Yeah, it is almost 12.
Yeah. Well, it's the pivot to. Oh, it might be. You know what? It might be a little bit shorter. It might have broken out just a little bit ahead. But you're saying it's say 60%, 60 something percent.
And I guess the last one, Amdocs. This is our large cap.
DOX, right? Yep.
Yeah. IT services, cloud native, open and dynamic portfolio digital solutions, platform services. It generated $4.2 billion in revenue in 2020.
Yeah, it's big.
So it's about $9.5 million now. It's been flatlining for a while.
Mm-hmm.
I'm not sure if what do you got? A cup and handle here? 2 cups and handle?
Yeah, there's a couple of handle, but this one.
Saucer.
Yeah, I mean on a relative strength basis. I mean it makes sense. It's just it's kind of a flatliner. They're a dividend play probably.
We're in
also.
at 63.49.
Okay, perfect. So there are a few ideas that are worth considering. Adding your watch list. Yeah, as you can see, it was pretty cool that Jeff was using a number of patterns on MarketSmith to help him decide when to enter some of these stocks. So Jeff, thanks so much for joining us today.
Pleasure is entirely mine. Hopefully we'll do it again.
Absolutely. Next week, we are going to have Charles Harris on the show. Charles is a longtime portfolio manager in-house of Bill O'Neill, and he's also a part of O'Neill Global Advisors. So that's it for this week on Investing with IBD. I'm Marusha Paris, and thanks for listening.
And for this week's notes and charts, make sure to go to investors.com/podcast, where you'll find details for each episode in the podcast episode section. And make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.